is Lab Denver, and also Byron Schultz, who is a lender and the branch manager with Diamond Residential Mortgage. Like before, if you can mute yourself, you can hover the mouse on your box and mute yourself. This will avoid interruptions to, thanks, Jose, to the presenter. And also, we do recommend that you leave your video on so that we can see you and have some interaction with you. You don't have to do it if you don't want to, but we truly recommend it. And also, there's a box on the bottom that's the chat box. I would like for everyone to click that box so that you can stay connected with us and ask your questions there. I'm also going to be providing a sign-in link. It's very important that you sign in there so that we know who participated. And if we have handouts to send you, that we can send those to you. Also, if you're a TRIO student, we highly recommend that you sign in so that you get learning credit. Other than that, if you have any questions, put them on the chat box and sign in. With that being said, Andre Witt, would you like to start?
Oh, there he is, just in time. Hey guys, good to see you again.
Hey.
Byron just hopped on. Thanks for the follow-up questions. Either we responded to you or we'll address a lot of the questions kind of left outstanding from last week, this week for sure. So how this is going to work today is we'll touch on like the last, I don't know, 7 or so slides from last week that we just kind of rushed through just to make sure, you know, a lot of it has to do with loan types and stuff. That answers your loan questions. And then we'll get into the fun part, my world, which is the house buying side. So I'm going to turn this live. Byron's going to lead you through the rest of the finance stuff. Again, and then I think we'll recap a lot of the questions from last week to kind of finalize week 1, and then we'll move on to week 2. So like Stephanie said, please use the chat box. You know, we'll stop every few slides or so to answer your questions. And yeah, great questions, great conversations going, so keep them coming. All right. Let's see. Can you make me a host, please, Sam or Stephanie? There we go. Slideshow. Hold. You guys good on your end? Let me get through this. Oh, jumping too far. Okay. So quickly, we're going to run through pre-qualification versus pre-approval. Byron, do you just want to quickly?
Yeah. So, you know, when you guys are ready to start the home buying process, the big thing to make sure when you get pre-approved or pre-qualified is that you're providing your lender with documentation, right? So one is basically saying we ran credit and you told us your income was $1,000 a month, there's a week, $1,000 a day, whatever that is, but we haven't verified anything. So what listing agents and what you're going to want to have before you go out shopping is going to be, you know, fully documented through underwriting, where they've gotten tax returns, pay stubs, bank statements. So they've verified, you know, the assets, your income, liabilities, all that. And that's what a listing agent is going to ask for. And the good ones before they'll consider your offer are going to want to talk to your lender to make sure that that's all happened and that there's not going to be any surprises or hiccups down the road, because in our competitive market we typically see that they have a lot of choices when it comes to buyers. So you want to make your offer as strong as possible by doing all those steps up front, to give yourself the best chance of getting the home you want under contract the first
Yep, cool. And
time.
again, we briefly touched on this last week, but this kind of proof and all these gatekeepers, like the underwriter that Byron mentioned, works for the lender, and they're the final gatekeeper. So they ask if they have any questions at all about your income, about your credit, about your job, about anything that potentially raises a flag of question. They're gonna find out. So they are the people that dig as deep as possible to make sure that you're legit and you have the funds to pay, right? And this is a big difference between, I know a lot of people wonder what the difference between the market today versus back in 2008 when the housing collapsed. This is a big part of it, is there wasn't need for proof. So you could say that you made $1 million a year, and there was a lot of predatory lending going on. So if you went and talked to one of those shitty lenders and you're like, hey, I make $1 million a year, they're like, cool, here's $1 million loan. Obviously, a lot of those people didn't have that money, so they couldn't pay the loan, which is why they foreclosed and everything just started to crumble. So, as annoying it may seem, proof is very important to keep the market strong. All right. Do's and don'ts. Again, we quickly talked about this last week. But if you're thinking about the home buying process, these are some pretty important things to keep an eye on. Don't make
Yeah, a good rule of thumb is, from the lending perspective, if you're going to be buying a house, do not give your social security number out to anybody, because most likely they're going to be running credit, and we're going to see that. We do what's called a fraud guard, all the way up until closing. So we see if you've even inquired about new lines of credit, whether it's a credit card, Home Depot, a new car, a new house. All those have to be explained and verified. So once you go under contract, typically between that and closing, don't give that out other than honestly maybe your insurance agent when you're shopping for homeowners insurance. Other than that, the good rule of thumb is just not to do that before you close on a loan.
Little bit about how lenders and credit looks. This is kind of
Yeah, the credit score component, it's made up of a lot of different factors, and there's an algorithm to it, but the things that we know, obviously payment history, so making on-time payments, very important. So late payments, whether they're 30 days, 60, 90-day late, those significantly hurt your credit score. Debt owed, it's a double-edged sword. Like, you definitely want debt, but it needs to be paid on time and be managed well. So it can hurt you if you have a lot of debt and you have late payments and you have high credit balances, things like that. Installment loans are looked at a lot differently than revolving accounts. So a revolving account is like a credit card, which is like an open line of credit. You use it, you pay it off. An installment loan is something that has a fixed term where you're paying it off over, a certain amount of time. So it could be a car loan, a 5-year car loan. It could be a 30-year mortgage. Those are a student loan. Those are considered installment loans, whereas a credit card is revolving. Installment loans are very favorable for your credit because it shows that you can pay on time consistently over time. A lot of people say, I pay my credit card off every month, but it's not helping my credit. And it's a weird thing, and I'm not sure why that is, but they like to see regular monthly payments. So if you're paying on time or paying it off every month, you're not really showing a history of paying consistently, which is a little counterintuitive. And then length, age of history. This is huge. So a lot of people, they might close an account and wonder why their score went down. Well, because that time you've had that score and you've been paying on time, if that goes away, you no longer get credit for making all those payments. So even if you're like a credit card you finally pay down over time, don't close it, just keep it, because it's good to show that you've had credit for a long period of time. And that's what they're looking for. So inquiries, new credit, we kind of talked about that, but anytime there's a lot of inquiries, that multiple inquiries can hurt your score. So it's like if you're shopping for a mortgage and you go to one or two places and talk to a couple of different lenders, not going to hurt your credit. If you have 20 inquiries, you're shopping for a car and furniture and a house, like they're going to start saying like you're looking to incur a lot of debt, and that is a red flag and can potentially lower your score.
Cool. And this is one, obviously everybody's situation is going to be different. So, when you go to Byron or another lender and start the pre-approval process, when they pull your credit, they'll be able to, they'll walk you through it and let you know, oh, in order to get your rate up, your score up, 20 points, you can work on paying down debt, maybe open a new credit card, whatever they can do to help you boost that score. They'll let you know. So very important to work with a lender that knows what they're talking about. All right. Again, kind of some quick action steps. Obviously have a budget. It's great that Stephanie and Sam are hosting these seminars regarding budgets, right? Obviously real estate's a great vehicle for that, but obviously you have everyday life. So having a budget, just being conscious with your credit balances and stuff like this. But again, this will be formulated to you specifically once you start that pre-approval process. All right. So I know this is just a quick thing, start when you're thinking about starting the process, start gathering your documents, talk with lenders and realtors and find somebody that you want to work with. And it's very important that your realtor and that your lender have a good relationship, because they're a team through this whole thing and they need to be on the same page throughout the entire process up until closing. Have an idea of your credit report and your credit score. And that's it. So day one, I know we'll get to the questions now. A lot of DACA questions. So Byron will go into this about kind of where the program stands, right now as a government kind of entity in a government program. A lot of those have been frozen for the time being just because of the current situation. Unfortunately, a lot of those government backed loans and programs, again, are completely on a standstill right now. So Byron, if you want to talk them through this.
Yeah. So, again, to Andre's point, everybody's situation is going to be a little different. So this is, just meant to be a high level overview, but, so DACA still exists as far as like being able to lend and purchase a home as a DACA recipient. But number one, FHA does not lend to DACA people, and it's only Fannie and Freddie, so it's conventional financing. So number one, they're gonna have higher credit score requirements, typically 680, 700. Go ahead.
FHA is, when we talked about loans, FHA is the government-backed Federal Housing Authority loan.
Yes. So they are not going to lend on DACA borrowers where Fannie and Freddie do allow it. High level, what we kind of initially look at, social security number, you've had it for 2 years. If you don't have that, then a valid I-10 for 2 years. You have to file taxes for the last 2 years, and you can't have used somebody else's social security number for employment or credit history. So all that has to match up. The other big thing, we're going to validate social security number through the IRS, and you have to be legally present, with your employer authorization documents. So what we're seeing, and this is just like Fannie and Freddie's guidelines. So what happens is you have investor overlays where, these are the requirements by the program. However, for somebody to take that loan, they might have their own requirements on top of these minimum requirements. And what we're seeing right now with all the craziness with forbearance and people not making their mortgage payments or not having to, as well as the potential for job loss or job reduction in pay or hours. There's a lot of overlays that are coming down that say either we're not taking these right now, or the requirements are getting a lot more stringent because if you think about it from an investor standpoint, the number one concern is ability to repay a loan, right? They're giving you money and they want to make sure that you're able to repay them. Well, with so many people losing their job, being laid off, being furloughed, DACA employee citizens they're they're going to be impacted as well. So that's a concern for investors that are saying, is your employer still going to sponsor you? Are you going to be the first to go? So with that being said, there's a lot more oversight on the program. So unfortunately, right now, like, it's probably not the right time to be looking at this program. With that being said, I do think and I feel confident that when all this stabilizes it again, we should be able to get back to business as usual. And this will be an option without all the crazy overlays or, just the flat out no's within, 2, 3, 4 months, like I said, when all this goes back to normal.
So again, this is the info, kind of the minimum info. You need to know as far as documents go for DACA. Again, each lender, each bank is going to have those overlays, so you might go talk to one lender and they're like, hey, yes, we're still doing this, but you have to have at least a 700 credit score. You've got to have this specific debt to income, right? So they're setting their own terms based on the risk that they're willing to take, as a company themselves. So you can see them, again, some just say flat out no, some say yes, but you need to meet this criteria. So kind of all over the place. Obviously, if you're a DACA borrower, DACA citizen, and you're thinking about, you need to buy something in the next month or two, definitely reach out and we'll get you in touch and we'll help you find a lender or a bank that will do this. But again, it's going to be kind of a case-by-case basis. And if you really need to buy right now, I'm sure there's ways to make it work. But again, based on a specific situation, definitely reach out and let us know how we can help. Cool. Oh, that's it. Byron, are you watching the chats? I can't see them in the display. Do we have any questions?
There is a question about how long after opening a new line of credit can one buy a home in terms of not affecting your chances of being approved for a house loan. Do you see it?
Yeah, I'm trying to understand opening like a new line of credit. I mean, again, it's a case-by-case basis, but when you talk about a new line of credit, if you're a 700 credit score or 750 and you open a Gap card, typically it's not going to affect you, and it goes into your ratios. But maybe you're 620 and you open a new line of credit and it drops you below that level. Well, CHFA's minimum requirements is 620. You open that card, it could drop you down, and it might take a month or two to get your score back up. So it does vary, but that's why you want to be conscious of what you're doing. And if you already opened it, there's not a lot you can do at that point, but it's about being strategic and starting early. That's why we always encourage our buyers to start the process 4 to 6 months out. Let's say you want to buy in December, you should be talking to a lender June, July, so we can get a game plan together if there are issues, if you did just open a line of credit. And then a good lender can help coach you through the do's and don'ts of your specific situation to say, yeah, if you need to go buy a car, you're good because, your debt to income ratios are low, your credit's strong, and, you're going to be fine. It could be somebody else that, it's super tight. We need to work on X, Y, and Z in the next 3 months to get your credit score up, and you can't do anything else different if you want to get into this house by December. So it's a case by case basis. But as far as like affecting your chances of being approved for a house, it's, you know, if it's done, it's done. We have to figure out a solution going forward. But if you're going to start the process, I would consult your lender and kind of verify, hey, I'm going to go do this, or I need to do this. Is this okay? Will this affect me? Or is there another option?
I think the point being, right, if you're thinking about buying a place in the next, honestly, like the next year, talk to a lender ASAP, and they'll be able to answer that question specifically for you, you know, once they see the rest of your credit report and your debt to incomes and et cetera. So yeah, again, if you're thinking about buying in the next year, go do this pre-approval process so that they can specifically cater a plan for you based on your situation. Any other questions? Byron, can you pull up the list of questions that we had from last week? And we can run through those real quick.
Yeah, I'm just looking at this. So should we start with our own credit or banking institutions, question mark, pertaining to a lender?
So I think what they're asking is, you know, if they bank with Chase, should they start with Chase? I'll quickly put in my 2 cents, right? Ideally, when you're in the market, right, you want to differentiate your offer, right? So you have to go in expecting you're competing against probably 5 other offers, right? If 3 of those other offers have a local lender that the listing agent has worked with before, that's going to go to the top of the pile versus somebody that's been pre-approved with Chase or a Wells Fargo or, you know, another big bank. Couple reasons. One, a lot of those bankers, you know, they're in a pit. So you're going to talk to 3 different people throughout the process, which, number one, a lot of times they won't be in Colorado. So your lender really needs to be sound on dates and deadlines and turn times for appraisals and a lot of back end stuff. Because again, Denver's a very unique market. So unless you work regularly in Denver, you're not going to understand the market. 2, banks work bank hours, and you know, a lot of real estate stuff happens on the weekend. So again, if a listing agent wants to vet out, you know, your lender and your strength as a borrower, they're going to want to be able to talk to your lender. If it's a Sunday, guess what? And you're using Chase, they're not going to have anybody to talk to. So you think they're going to wait 24 hours to talk to your person when they've already talked to 4 others? Probably not, right? So yes, it's a good idea to talk to a couple different lenders. So maybe, you know, start with Chase. They're going to gather the same docs. You'll have your docs ready, but then also go talk to a local lender, and you'll have stuff to compare. But also, just remember, it's your lender is very important in a listing agent choosing your offer or not. I hope that answers.
And I'll add this. You know, one other difference that I noticed, I started with Chase back in 2004, and you know, the difference in what like a Chase, Wells Fargo, B of A do from a lending perspective is a lot more limited than what, you know, a true mortgage banker can do. They are very cookie cutter. You know, it's 780 credit score, 20% down, and you know, if you don't fit in this little box, we can't help you. So what I've run into a lot is, you know, people that get turned down at other places and other banks. It's just those overlays that we talk about, that they have much stricter guidelines because they don't, the lenders there are typically less seasoned. And you know, I started there, but there's a lot more options that we have, you know, a Diamond at other places than a Chase or Wells Fargo, because they have, you know, just a very limited product mix of what they're willing to offer and what risk exposure they're willing to take. So they don't get very creative, and you know, they have a lot of other areas that they focus on, whether it's depository accounts, investments, life insurance, you know, credit cards. So they're kind of doing everything, whereas all we do is, you know, mortgages. And that's where we can set ourselves apart, and that's where a lot of listing agents like to see hey, if you're working with Chase and something goes wrong, a lot of times the deal goes dead. Whereas, we don't have just one answer. We have a lot of different solutions so that if something pops up or something changes, it's not just an automatic denial, deal's dead. It's we can figure out and solve a problem.
Yeah, Byron saved a handful of deals for me. Borrowers, obviously they want to keep all their financials in one place. So again, to your point, they start with whoever they bank with, they have insurance with, all of this. But to Byron's point, deals aren't always smooth. So when they get rough and sticky, you need to have a go-to that you can literally, I can call Byron 10 tonight and he'll answer the phone. So again, having somebody on your side like that is very important. And as far as
right. I mean, tell them about, I forget who it was, but you were showing a client and the listing agent literally told you they wouldn't accept your offer from that lender. I forget if it was like USAA or something. It was, and not to say that they can't get the deal done, but it's like there's going to be agents out there that have been burned by certain institutions, and then all of a sudden they're jaded and so it's again, it's double-edged sword because it's not that they can't do these. It's just sometimes it can be the difference in you getting an offer accepted or not.
Yep, exactly. Do you want to pull up that other list? Can you pull up that list of questions? Unless there's others in the chat that we should touch, and then let's get moving.
Yeah, Dre can provide you a list of lenders you can contact. How long after graduating, getting a job, should we expect to wait to apply for a home loan? So if you've been going to school, and what we want is a 2-year history, 2-year work history, and education counts as part of that history. So if you've been going to school for the last 2 years, then you get a job, you can actually apply for a loan immediately. We just want to show the 2-year history that, and what we would require from your time at school would be a copy of transcripts and then a diploma showing you graduated. And then we can use your current work history without 2 years of on the job experience. Would you recommend that DACA and I-10 folks start working the pre-approval process ASAP, or wait until they open these loans up? I would say if you kind of meet those initial criteria of Social Security number for 2 years, 2 years of tax returns, and then you've got your EAD in place, definitely start the process, but be realistic and understand that it might take a few months, and you want to get dialed in to say, manage your expectations of, let's get the process started, let's see what we're missing, let's gather everything, and then it might be a matter of, hey, once this guideline goes back to normal, you can start shopping and you can start making offers, versus I think you're going to be ahead of the game that way versus waiting until, okay, the guidelines have changed, you can do this now get me all your docs. Now you're behind the 8 ball. And I think there will be some deals to be had after this initial kind of stay home stuff goes away, the showings go back to normal. The people that are in a position to move might have some opportunity there. I'm not sure what list Brian is asking about. Oh, the list of lenders. Yeah, Dre can send that out afterwards.
Good.
Let me find that email.
We might have touched on a lot of those points already, but just anything outstanding. Should we come back at the end? Or you got it?
Give me a second. There we go. What will home insurance amount usually be? Depends on purchase price and property type. So good rule of thumb in that $300,000 single family home range, $150 estimate for a month for homeowners insurance. If you're doing a condo, estimate maybe $75 a month, but then you've got HOA fees on top of that. So just kind of budget accordingly. Obviously, it depends on deductibles and claims history and credit, but I think that's a good rule of thumb.
Real quick, the,
Um,
the reason the reason like condos and townhomes have cheaper homeowners insurance is because typically the HOA of the complex covers the exterior. So everything from your walls out will be covered by HOA maintenance wise, and walls in is you. Whereas a single family, you're responsible for the entire structure. So that's why it's a little less for attached homes.
Thanks for that, Dre. Curious about construction loans. I think we touched on that, but they do exist. Difficult to find land to purchase, as well as a builder that can get your home built in a timely manner. So not impossible, but in our market it's not where a lot of entry level. You're not gonna get your first home there in the $300,000 price point. But you can look at like existing builds. I don't know if like Dre, maybe like Green Valley Ranch, if they've got new construction up there where that's already in place.
Don't plan on construction loans. If that's an avenue you want to take, reach out individually. We can talk about it.
Yeah. Best time to buy your first home, waiting until after COVID-19. I think it's a good time to buy if you are, number one, secure in your job. If you feel confident that you're going to continue to be employed, your job's not going anywhere, then I would definitely say, it's always a good time to look. If you can, any edge you can get to maybe get into a house, take advantage of that. But you want to be confident that you're going to be able to continue to pay your mortgage before you make that commitment.
Also, with that's a good question. Literally in the last few days, it's changed because currently it's not allowed. Like in-person showings aren't allowed. Open houses are not allowed. So really, the only reason you should be buying now is if you have to. So if your lease is up, or if for whatever reason you will not have a house unless you buy, obviously buy. Otherwise, I'd suggest wait this thing out, because with no in-person showings, what that means is you're having to buy most likely the biggest purchase of your life without even freaking seeing it. That's insane to me, right? So how I'm working around this, right? I do have a couple clients that need to move. So what we're doing is, it's not really a gray area, but we're saying, hey, we've done the virtual tours, we've done a virtual open house, all of this stuff, and we want to make an offer, but I'm making our offers contingent on a physical inspection. So not just the house inspection, which I'll talk about here shortly, but also like having the person actually get in, because a big part of buying a house is the feeling that you get, right? So if you walk in and you're like, ugh, like this doesn't feel right, for whatever reason, that's a way for us to get out. So will you be able to see it in person? Eventually, yes. If you don't like it in person, can we terminate? Yes. But make sure, again, if you're having to do it here in the next couple weeks, that you've got a realtor that's putting protections in place to make sure that, again, you're protected in case it turns out to be, a shitty house and you don't want it. Okay, sorry, that's all for that one.
Yeah, that's good info. Back to contract. If you see a for sale sign, it says under contract. So that just means that the sellers have accepted an offer from a buyer. They have not closed on the house, but they are going through the process. So, the buyer is getting an inspection, they're getting an appraisal, they're having their file underwritten for their loan. So that's what that means. Typically, Dre can talk about this a little more, but you might be able to submit like a backup offer if they blow out or terminate, but it's not final, but they've picked somebody to buy their house.
Yeah, and typically when a house is under contract, the showings have stopped, right? Think about if you're selling a house, you've got an awesome offer that you accepted. you don't want strangers going to your house still, right? The whole point of touring and showing your house is to get an offer. Once you've got a strong offer, a lot of times, unless the house is vacant, maybe, but once contract is a house is under contract, it's gone unless something happens throughout the process and they come back to market. In that case, you can go through, but while it's under contract, it's pretty much a done deal.
Yeah. Cheat sheet for recommendations to prepare financially. I don't have anything PM, but prepare, for a down payment minimum 3.5%, closing
We'll put
costs
something together.
anywhere from what's that?
We'll put some together.
Yeah, closing costs 3 to 5 grand. Make sure when you're looking at payment scenarios, you're factoring not just principal and interest, but taxes, insurance, HOA fees if there are, mortgage insurance, just so you don't have payment shock when you close on the house, and all the bills that are associated with owning a home. We'll put something together. What does someone need to qualify for down payment assistance? So CHAPA allows down to 620 credit score. There's some other programs that are 640 minimum. Income varies. They have income limits anywhere from 72,000 up to 139,000, and then typically they want your debt to income ratios below 45%. These down payment assistance programs, keep in mind, they're seeing some of the same issues as the DACA program that we talked about, where there's some overlays that are coming from investors. So while like a CHAFA is still going to buy the loan, they don't fund the loan. So finding somebody to fund that initial loan before it gets sold to CHAFA is difficult. I ran into a situation where somebody was denied by, I think, American Financing. They had a 660 overlay on credit. So even though CHAPA allows 620, American Financing will not do anything below 660. So they were denied and, came over to us, and we have a 640 overlay. So before all this happened, it was just, you could go down to 580. So it's just a weird time right now. And it will get back to normal, but there's just it's a lot of case by case specific scenarios. Wish we could tell you more like matter of fact, if you have this, and this, you're good to go. But there's just so much going on right now that it honestly changes from day to day.
Okay, I'm gonna get going here, like with the presentation, because
Okay.
we're boring me. Okay, so let's go house stuff, and I don't want to run out of time again. So once you're pre-approved, what's it look like, right? So quickly, this might seem like common sense, but just want to make sure some of the parties involved, right? Obviously, there's a buyer and there's a seller, and there's a title company. So the buyer is the one buying the house. Majority of time, people are represented, and almost 90% of buyers use a loan, meaning there's 10 to 12% that use cash. Sellers, obviously, the ones selling the home. 92% are represented by a listing agent, meaning a realtor selling the house. They're not a FSBO, which is an FSBO, a for sale by owner. Those are more rare and more rare these days, especially with all the technology behind real estate in the process. If you're just a Joe Schmo, there's a good chance you're not going to get top dollar for your house. And that's why I have a job. So you can see right here, this little figure, right? Always remember that if you're a buyer and you don't have a realtor and you're interested in a house that has a realtor, you need somebody fighting for you. And that's what I do, right? So if you're buying, again, you need a professional that knows what the hell they're doing, how to navigate really sticky situations, and that they have your best interests in mind. Cool. Title company, this is the one that kind of handles the whole transaction. They check the history of the house to make sure there's no liens on it, and they ensure that you get a clear title when you buy a house, so that there's not like a mechanics lien or something that now that you own the house, you now own that mechanics lien too, right? And the title company is also who handles the closing. So when you go to sign the final papers, it's going to be at the title company's office. And there are a bunch in Denver. I have a few that I work with regularly, but costs are pretty much the same. It's really just kind of who you have a relationship with. All right, so again, you've worked with Byron, you're fully pre-approved, you're ready to go. For timeline purposes, I always suggest, say you have a lease coming up, right? I always suggest start the home buying process similar to pre-approval, like sooner rather than later. Typically, you need to plan on average. I think in Denver, buyers look at an average of 10 homes before they get one, and they make an average of 2.5 offers before they get one accepted. So the more time you have, the better, because more than likely, you're going to be seeing a lot of homes and making a couple different offers. So you want to make sure you have enough time to do that, right? So what'll happen once we have your budget and stuff, I don't know how clearly you can see this, but this is what a home search portal looks like, right? So there's Zillow, there's Redfin, there's all these consumer facing sites. Couple things about those. One, all the info that they pull comes from this. This is the MLS. This is the holy grail, the Bible for Denver real estate, right? If anything is on the market, it's going to be in the MLS, right? Eventually, Zillow will pull this, but number one, it's not up to date. So the actual MLS updates every 15 minutes. I think Zillow doesn't seem like much, but it's a few hours, right? Not only that, but if a house, Zillow is mainly a marketing platform for realtors, right? So you can think of it as like a Wikipedia for real estate. Anybody can go in there and list anything, right? So is some of it accurate? Yes. Is a lot of it not? Yes, right? So number one, can be fake listings. Number two, it could be a listing that sold 2 months ago, but the listing agent wants to continue to receive calls on that house, so they'll leave it up, right? So use this MLS portal that your realtor sets up for you as kind of the comparison, right? So if you see something on Zillow that's not showing up in your portal, ask your realtor why, and they should be able to let you know. Okay. Second, make sure that your realtor is very active and involved, right? There's a lot of opportunity for coming soons, for pocket listings, which are listings that haven't been put into the site yet, but maybe the seller has 5 kids and they don't want to show their house, so they want to try and get an off-market deal, before going to market. So somebody that's very active and involved in networking in realtor groups, stuff like this is important. So once they set up your portal, it looks like this. So whatever your budget is, you'll put it up here. Oops. In the price section, this is where you can set your minimum bedrooms, minimum bathrooms, location. There's a ton of filters that you can add in here. But one thing I do suggest is when you're doing this portal, cast a broad net to start, right? Because this is only as good as the people that input the information, right? The listing agents. There's a lot of lazy and shitty realtors out there that don't put all the info in the MLS for their listings. So if you're going to, if one of your filters is a 2-car garage, there's a good chance that it sounds crazy, but realtors don't add 2-car garages, or maybe something more specific, like, I want a kitchen island or mountain views. The more granular you get with your filters, the more likely there is to be an error, right? So cast a broad net. Here's my budget. I want 3 beds minimum, 2 bath minimum. Boom. See what you got, and then manually filter from there. Hopefully that makes sense, right? So again, cast a broad net, and then slowly you can hone in your search. That's it. Yeah, and every day you can receive updates from your portal, right? So you can set it however often you want, but say you want it every day. So every morning at 6 a.m., you're going to get an email from me that shows any new listings that hit the market in the last 24 hours that fit your criteria. If anything, if an under contract that you saw for some reason blows out of contract and comes back on the market, you'll get it every morning. So things like this. So this is a way to stay up to date and have a heartbeat on the market. Do your due diligence, right? So again, we're going to cast that broad net. Hopefully, you're taking time, you're taking weekends to go explore new neighborhoods that you think you have interest in, right? A lot of times with my clients, if they're 6 months out, we'll pick a weekend or two every month. We'll go explore a different neighborhood, look at a few houses in that neighborhood, go have a beer at a local, brewery or bar or something, just so they can get a feel. And then after that day, we say yay or nay. If it's a yay, we'll keep it in their portal. If they're like, we don't like this area, then we'll remove that from their portal, from their search, so that again, over time we can slowly start honing our criteria in our search, so that when you're ready to get serious, we have that set and we know everything that you're seeing are potentials. Good. Also, there's open houses all the time. Well, there used to be open houses, right? So again, doing your research and just exploring as much as you can is great. Same thing with schools. Legally, I'm not allowed to talk about school systems or if they're good or bad. So there are some things where I will tell you, I straight up, I can't guide you or steer you in any direction. So if specifically like schools or crime or things like this that I can't talk on, I'll give you resources to do that research yourself. Good. Anything in the chat?
I've been answering them as we go.
Okay, cool. All right. So we got a portal, right? And again, this is how I work with my clients, right? Every realtor is going to be different, but make sure they, again, know what they're doing and have a plan that works, right? So this is kind of how I talk through it with my clients. You got to remember that this is your first house, right? It's not going to be perfect. Even if you build a house, you're going to find stuff that you want to fix after a month because you're going to see a new TV show or a new flip it or flop it or all that shit, right? You're going to watch it and you're going to get inspired, Pinterest, whatever. So remember, this is your first house. It's not going to be perfect, okay? So I guide them by saying, create a top 10 list, right? The top 3 items are non-negotiables. So you're like, you know what? It's just me. I only need 1 bedroom. I only need 1 bathroom. Boom. There's number 1. Number 2, I've got a dog. I need some sort of outdoor area, right? Non-negotiable. Number 3, I need off-street parking, right? I'm interested in a condo in Cheeseman Park, but street parking sucks. So I need, somewhere to park. Boom. There's number 3. The rest are going to be, interchangeable. So I want an open concept. I want, a ranch. I want, again, things that they'd be nice if you had them, but if they don't, it's not a deal breaker, right? So with that, and obviously it can change over time, as we see houses and stuff, that can be a fluid list. But if a home that you see on the portal or that I send you checks 6 of your 10 boxes, obviously the top 3, and then any other 3, it's worth a look. 7, very, very rarely you're going to see an 8, but be prepared to have, 6 or 7 out of 10 that you're going to make a move on. Again, inventory is super limited, so make sure you have these expectations going in. Cool. And then, like I mentioned before, plan to see, at least 10 homes. I have had clients that the first one they see, they're like, this is it, let's go. Awesome, we've made an offer. And then there's more people, that want to see more houses before they feel comfortable pulling the trigger. Both are completely fine, but one thing I caution you, don't have the grass is greener syndrome, right? If you see a house, it's got 7 of your 10 boxes checked, again, that might be as good as it gets. So I wouldn't wait another week to see what else you see, because there's a good chance in that week that house that you just looked at is going to be gone. Cool. All right. expectations again, you know, it's not going to be perfect and it doesn't have to be, right? Always remember your first house is your stepping stone home, right? So you're using this first step to get into your forever home, right? Very, very few people can afford, you know, the 4 bed, 4 bath, 1 acre, beautifully crafted house, right? Eventual goal for a lot of people, yep. First house for a lot of people, nope, right? Buy a little condo, right? That in 3 years, you're going to have some nice equity you can pull out of to step up into your next home, right? Into your second home. You keep that condo as an investment, right? That you're renting out, somebody's paying your monthly mortgage. So in 3 more years, guess what? You've got that equity you can tap into again, plus the equity in your second home. Then maybe you're buying that gigantic, awesome house, right? So again, stepping stone home, always remember that when you look at a house, obviously you want to live there now, but also you need to know your options and your outs, right? So in 3 years, when you're ready to move on, is there good equity? Has there been good appreciation? Is it rentable? Right? All of these things are things to consider when buying. Okay. And again, a great realtor will talk you through this and kind of guide you. So expect to see again 10 homes, make a couple offers. These two are big, right? It's Denver is crazy, especially in the first time homebuyer sector, which is like houses 500K and below, right? Multiple offers, expect to go in swinging and be competitive, right? I always say expect to pay 10K more than the list price. So if a house is listed at $300,000, expect to go in with an offer at least 310, right? Obviously, if we can get it for lower or below ask, I'll make it happen, but don't expect it because it's very rare. And remember, you know, again, you're competing, right? So just because a house is $300,000, if you submit an offer for $300,000, it doesn't mean the seller's going to take it, right? If they have a few more, one at 310, one at 315, one at 320, those are what you're competing against, right? So again, if it's competitive, expect to get creative and go over ask. If it's not, I'll get you the best deal that I can. Second thing is contingencies and concessions. I think this is on your real estate terms glossary. But what a contingency is if something needs to happen for you to purchase the house, right? So a lot of times, like when you're going to buy your second home and you need to sell your first home, you know, for your down payment, you make an offer contingent on selling your house first, right? Again, that makes things complicated in a multiple offer situation because if there's 3 offers, right, 2 are non-contingent, meaning they don't have to sell anything before purchasing, and then yours is contingent, yours is going to go to the bottom of the pile, right? So contingencies are very tough in this market. The second thing that's very tough are what are called concessions. So, you know, a few years ago when things were a little more mild and less competitive, um, you would build closing costs into your offer, right? So closing costs you can typically plan on about 5,000 bucks, right? And this includes your title fees, your lender fees, your escrows, your taxes, things like this. So plan it on 5,000 bucks, right? If the house was 300,000, you'd make an offer for 305,000, right? And the seller would use that extra $5,000 and pay for your closing costs at closing, right? So it's less money out of pocket. You build it into your loan. 5,000 bucks is roughly $30 a month payment, right? So depending on how long you plan to be in the house, more than likely you're going to be out before that break even point. So it makes sense, right? But again, concessions in this competitive market are rare. And a big thing there is because of appraisals, which we'll get to. But I'll touch on this point again. But if you've heard about, you know, friends having closing costs paid for or things like this, Did it happen at one point? Yes. Is it still possible? Yes. But don't expect it because it's very difficult in this competitive market. All right. Questions? Anything?
Uh, One person just asked, if contingencies are not great to do, how do you know when you should do it? Guessing it's just if you have to, right?
Right. Yeah. I mean, if you're like, look, we need a bigger house, but we need to, sell our 1-bedroom condo first. Then there's a couple ways to do it. One is you list your house, you put it under contract, and you have what's called a post-closing occupancy agreement, meaning, you'll close on your house, you'll get the funds in your bank account, but essentially you can rent your house back from the people that just bought it for up to 60 days, right? So you close on your house, but then that means you've got 60 days to find and to close on a home, right? Worst case,
Hey, good. How are you?
worst case scenario in that
Let me
is after 60 days, you don't find a house, right? Then at that point, you have to figure out, what your options are. Can you go stay with parents? Can you do a short term? Whatever, right? That's the risk there. Number two is you find a house and a seller that are willing to take a contingent offer. Again, is it possible? Absolutely, especially at the higher price points where there's less buyers for every listing. But if it's in that under 500K price point, it'll be difficult because more than likely there's going to be multiple offers. So I hope that answers your question. Yeah.
Do you recommend a fixer-upper?
Ooh, it depends. What do you mean by fixer-upper? Do you mean like cosmetic stuff? Or are you adding bedrooms?
Yeah, we'll see if they respond or elaborate on that. What happens if your appraisal comes in low? So, great question. From a financing perspective, we can
Here, Byron, real
only.
quick, I'm going to touch on that in these next slides.
Okay.
So we'll get back to questions after I get through this next part because this might answer some stuff. All right, so we're under contract, right? Got the offer accepted. Now what does it look like, right? For timeline purposes, once you go under contract to once you close, plan on, typically it's 30 days, right? So if you went under contract tomorrow, right, April 15th, plan on closing on May 15th, right? So again, plan for 30 days to get from under contract to closed, okay? One good thing about Colorado contracts to buy and sell real estate is they're very buyer friendly, right? So there are a few opportunities to terminate the contract with no consequence. All right, so I want to touch on these real quick here. So these are kind of out of order just because of how they're laid out in the contract, but I'll kind of dive back and forth, right? So your first most important deadline, right, is your earnest money. So once you're under contract, you've got 72 hours to turn in this earnest money. This is on your glossary sheet as well, but quickly, this is really a deposit, right? It is a refundable deposit based on those few deadlines that you can terminate legally with. But plan here on 1 to 2% of the purchase price, right? So on a $300,000 house, it's going to be probably right around $3,000, right? So this earnest money, again, is due within 72 hours and it's held by the title company that's handling the transaction, right? So 72 hours, you wire or you turn in a check to the title company. Good. Step one. Step two, the house inspection, right? So typically you've got about 2 weeks from going under contract to conduct a house inspection. So the sooner the better, because if something comes up, that you can't reconcile with the sellers, then you want to terminate that contract sooner than later so that you can get back out there so that we can find another one, right? So again, typically 2 weeks, you hire a third party professional home inspector that comes in. This is an out-of-pocket cost that you incur as a buyer, right? And I always say typically plan on about $500 here, right? So this inspector goes to the house, they spend 3 hours there just going through electrical, mechanicals, roof, foundation, all the pieces of the house, and they'll produce and send us like a 30 plus page report. Again, just kind of going through every item that they checked in the house, right? Um, Remember too, this is a used house, so it's not going to be perfect. They're going to find a lot of things, right, that are going to be different than a brand new house, right? So again, there's a 30-page report, but a majority of it is, just regular wear on a house. Okay. The items that the inspector has big concern about, he's going to note in there. And, if we need, again, an inspector is kind of an overview. If he sees something with the structure, maybe there's a big crack, in the foundation or in the basement or something. He's more than likely going to say, look, this isn't right. This isn't my specialty though. You should get a structural engineer out here to give you like a full report, right? So same thing with like a roof. If they're like, lots of hail damage, get a roofer out here, right? There's certain parts of the house that electrician, right, that have specifics. And if there are red flags for the home inspector, then he'll let us know to get a specialist out there, right? So we'll go through this report. We'll figure out, big money items. Obviously, we're going to ask for, but don't expect, kind of the rule of thumb is anything that costs less than $1,000 to fix is kind of expected in a house. Again, wear and tear, like a leaky faucet or something like this that you can fix yourself or go to Home Depot. Don't expect for the seller to adjust that. But big items, and again, I'll go through the report. We'll figure out, what we can and can't ask for. We'll put that list together in this deadline, the inspection objection deadline, right? So this is where we form our list of items that we want to ask the seller to address. So, hey, Mr. Seller, based on the inspection report, we want you to fix A, B, and C, right? Turn that into the sellers. Then they respond in this inspection resolution deadline. So they'll say, hey, Mr. and Mrs. Buyer, we'll fix all of them. Perfect. If that's the case, awesome. They could say, we'll fix A and B, but not C. Or they could say, hey, kick rocks. We've got 5 other offers that aren't going to ask for anything. So take it as is, or we'll terminate, right? 3 options there. Obviously, that's where some negotiation comes in, but it really comes down to leverage here. If they've got multiple offers, you could be kind of put in a little pickle, and you got to decide if you want to buy a house that's not perfect or if you want to terminate and try and find a better one, right? So this can be done if the seller says, hey, we're going to fix all of them. It'll be done before your final walkthrough, which is a few days before closing, and they'll provide receipts and scope of work for everything that they've had done, right? The second option too is they can say, hey, we're crazy busy. We don't want contractors. We don't want to worry about scheduling and managing all of this. So we're just going to give you a $3,000 credit at closing, and you can handle the items yourself, right? So a couple options there, but biggest thing here, right, is you're touring houses. Obviously, you're going to see some things, but remember, we're going to have this inspection done by a professional, so they'll catch anything that warrants, additional work or whatever. So this is the first chance to terminate the contract without penalty, right? So go through an inspection, and sellers don't want to fix anything. You're like, it's too much for us. Let's terminate, right? We'll terminate. We'll get that earnest money back, and then we'll get back to house shopping. Cool. Next one. Oops. HOA documents deadline. Okay. So this obviously is only if there's an HOA, a management company, right? So a condo or a townhome. Some communities have HOAs as well, but this is an opportunity. The sellers have to provide all of the HOA documents, and we'll go through everything to make sure it looks okay, and that's it, right? But if for whatever reason you've got 3 dogs and there's an HOA that doesn't allow dogs, but the sellers never disclose that. If we catch that, obviously that could be a deal breaker. Boom, we can terminate, get that earnest money back. Okay, so we've got inspection, we've got HOA docs, both reasons to terminate without consequence. The third, what Byron mentioned, and the question, the appraisal deadline, right? So this is typically, we give about 3 weeks for the appraiser to get out there and do his thing. Okay, so first thing, appraisers come from the lenders. So Byron would order the appraisal on your home. Okay, what the appraiser does is he uses comps, which are comparable properties. So similar homes, similar size, similar build, similar location. They look at what those homes have sold for in the last year to come up with a current valuation for your home, right? They obviously, account for updates and work that you've done on the home, but that's in a nutshell how they come up with their valuation, right? We have no control over who the appraiser is. Lenders have literally a hat with a pool of appraisers. They pick a name, that's who you get, right? So no choice there, but the appraisal gets done. Majority of the time, it comes back at ask, at value, so you don't need to do anything. But in the event an appraisal comes in low, right, you cannot get a loan for less than the appraised value. Okay, so
for more than the appraised value.
Sorry, yes, for more than the appraised value. So say we're under contract on a house at $300,000. The appraisal comes back at $290,000, right? What do? 3 things could happen. One, and ideally, right, the seller just says, shit, we overpriced the house. We're going to lower the price to $290,000. Boom, done deal, you can move on. Not likely, right? Especially if there's multiple offers. So second option is, and this is most common, you meet in the middle, right? So we were $10K short, right? $290,000 on a $300,000 house. How are we going to make up that $10K? Again, meeting in the middle. Seller reduces the cost, the list price by $5K, and the buyer brings $5K. But the thing is about this, that additional money has to be in cash, right? Because it can't be in your loan. So at that point, right, it really depends on the buyer's liquidity and if they're able to do that or not, right? At this point, if you can't come to an agreement with the sellers and the listing agent, then this is our third opportunity to terminate the contract, get our earnest money back, and get back out there. Cool. And then obviously the third option is the seller says, oh, sorry, again, we've got 3 other offers that have cash available. So they're going to bring cash. If you can't, we'll terminate. Right. So again, kind of 3 different avenues this can go down. But at the end of the day, if you're not happy with it, and if it doesn't make sense, we can terminate, get that earnest money back, and get back on the hunt. All right. Last one is this guy right here. It's called the loan termination deadline. All right. This is the final out. Okay. And legally, this can be no closer to your closing date than 3 days, 3 business days, right? So this loan termination deadline is the last out. So if throughout the process, you lost your job, or your wife accidentally bought a new car and it screws up your credit score, and now your debt to income's too high and you can't qualify for their loan, right? This is anything that potentially happens throughout the process that affects your ability to get your mortgage loan. This is the chance to get out, right? Final chance, again, to get that earnest money back and move on without consequence, right? Once we're past this loan termination deadline, again, you're past it and you're closed tomorrow and you lose your job. Is there that chance? Yes. Would it be shitty? Yes. Is there a good chance that, it's a situation out of your control and the seller will understand, and refund your earnest money? Yes. But is there a chance there's just a real big dick seller that is like, oh, you're out of of outs, we're keeping your earnest money. Yes, that can happen, right? So again, writing these deadlines in your contracts is imperative to your protection. So make sure, again, seasoned, vetted realtor that knows how the hell to write contracts in your best interest. That's it for, I hope that answered the appraisal question. And obviously there's a lot more dates and deadlines, but they're not nearly as significant as the ones that we just talked about. Questions on contracts? Anything?
What can you do if that happens? If what happens?
All right, we'll see if they respond.
I think they meant like if someone that you were entering in a contract with keeps your earnest money.
That's it.
Mediation, though, right? I mean,
No, I mean, if you're past your dates and deadlines, your earnest money is
right.
gone.
And you have to think of it from both sides, right, Dre? It's like when you're representing a seller too, if you're a day away from closing and somebody's terminating and you have to go back to market and you're planning on closing or you're contingent because you're buying another house and now you don't have the funds, like they're impacted as well. So that's partially why that's there is to protect both sides. So it's not always them being, jerks about it, but sometimes
Depends on the seller situation. Yeah, that's a very good point, Byron. If they need that money because they can't close on their next house and need to shack up somewhere for a month, then they're going to use that money to do that. So yeah, that's a good point. They might not be giant dicks. They might just like literally need that money, to make their next step. So yeah, if you're past all of those, dates and deadlines, your outs, right, of the contract, it's in the seller's hands. If they want to keep your earnest money, they can, and that's it. Yeah.
But I mean, typically stuff like that doesn't happen, 3 days. Like if you're a day from closing, I would hope you'd have an idea if you're about to lose your job.
Right.
We've done a lot of due diligence from a loan verification perspective, and we do have to verify all this stuff prior to closing. But you should know going into that, if you're 3 days out, you should have a good sense of confidence that that you're comfortable versus if there's something questionable, you should be talking with your lender, with your agent, being like, hey, I've got some concerns about passing this deadline because this is what's going on,
And so to that point too, right? Like always remember too, these dates and deadlines are our guide, right? But they can always be extended, right? Obviously both parties have to agree to that, but say you get an inspection and there's potential foundation issues and you want to get a structural engineer out there, if they can't make it out to inspect the house by your inspection objection, then you say, hey, Mr. Sellers, here's the situation. We can't get somebody out there until a day after this date. Can we extend that? More times than not, they'll say, yeah, we totally get it. So always keep that in mind too, right? It's the same thing, right? Loan termination deadline, especially now, right? If you're like, hey, Mr. Seller, like my buyers, they're not sure about their jobs, whatever. Can we extend this? You're that far along in the transaction. If I'm on the list side, I'll say, hey, yeah, take a couple days to figure it out so that we can try and make this work. So again, if you need to push these dates to make it work, more often than not, again, you can, but plan on this kind of guideline throughout the process.
Really quickly, I want to pause because it's 147 or 148 right now.
Yep.
Stephanie, I think, can stay on the call until 2. But were there other slides that we needed to cover or other
Nope.
questions?
This is the last slide. Just kind of some brief out-of-pocket costs. Your earnest money needs to be in good funds. So depending on the price point you're looking at, plan on, again, 1 to 2% of that. Plan on $500 for the home inspection. That's high, but plan higher than lower. And same with closing costs, right? Plan on about 5K. Obviously that will differ depending on the price point that you're looking at. If we can get some concessions built in, we will, but just plan on this. And then once you've closed, I always recommend, and a lot of times I'll get this as a closing gift, is a home warranty. So it's 1 year for your house. If anything breaks or whatever, you can call the company, they'll come out, they'll fix your fridge, they'll do whatever, and it's all part. You might have to pay a site visit, which oftentimes is like, I don't know, $50, but everything else is covered by the warranty. So that's, always recommend a good home warranty. And then just like a car, upkeep of your house. So clean your gutters, clean out your sewers, have them scoped, have your AC tuned, before every summer, your furnace, your water heater, all of this. The better care you take of your house, the longer it's going to last, but also, the easier it's going to be to rent and to sell for when those days come. Yeah, and that's it.
How much is a home warranty, Dre?
Typically like $500 or so. And that's $500